Welcome to Fiduciary Hot Topics for the second quarter of 2025. Hard to believe we're already here. So let's start off with some additional guidance that we have received regarding some of the provisions for Secure Act 2.0. The first is a set of proposed regulations that relate to automatic enrollment. Now, automatic enrollment provisions took effect in 2025, and it means that any new 401k or 403b plans that are set up must include an automatic enrollment and automatic escalation feature. So the regulations give us some clarity on what that means. The automatic enrollment setup has to be a minimum 3% automatic deferral that increases annually by 1% up to 10% each year. And then it can go also all the way up to 15%. The participant has to have the ability to opt out and also take out penalty-free withdrawals within 90 days of them being withheld in the plan. And what the regulations really clarified was that these rules apply to all eligible employees, and that includes our long-term part-time employees as well. Now, these regulations are not necessarily in effect yet, but they do give us an idea of what the IRS expects. And we'll see these finalized later on this year. A couple of the other things that the regulations clarified was that the investment option for the automatic enrollment arrangements, they must satisfy the DOL's qualified default investment alternatives. So the proposed regulations on automatic enrollment gave us some additional guidance as well for mergers and acquisitions, as well as for other types of plan amendments and when a plan might be participating in a MEP or a multiple employer plan or a PEP, a pooled employer plan. Now recall the automatic enrollment mandate applies to new plans that were established after December 29th of 2021. So if we have a plan that was established before that, that plan is called an exempt plan. And when we have a merger and acquisition, a plan that is exempt would more than likely want to maintain that exempt status. And that is possible if the merger and acquisition occurs within what's called the transition period. And that transition period extends from the effective date of the transaction until the last day of the first plan year, beginning after the date of the transaction. So if the merger and acquisition happens during the transition period, an exempt plan can maintain its exempt status. Now, for MEPs and PEPs, the regulations clarified that we are going to look at each employer individually rather than the MEP and the participants of the MEP as a whole. So looking at each employer independent and whether or not they are an exempt or non-exempt plan. And finally, any amendments to a plan, for example, if you're changing service providers or you're expanding eligibility, those types of amendments would not affect an exempt plan status. Also, with the regulations, we've got the clarification that there's an elimination of unnecessary plan notices. And this is nice because this will ease the burden for plan sponsors. So where this comes into play is when we have unenrolled but eligible participants. So they're eligible, but they just have decided not to enroll in the plan or have opted out of the plan. And in that case, there are the notice requirements are greatly reduced. There's only one annual notice, reminder notice that's required. And as long as that annual reminder notice explains the eligibility and the election deadlines, et cetera, and tells the participant or the unenrolled but eligible participant how they can get more information, then that satisfies the notice requirement for those individuals for the year. Next up, also with respect to the automatic enrollment regulations, we have clarification on how the plan-linked emergency savings accounts come into play. And if you recall, the plan-linked emergency savings accounts, or PLESAs, are small balanced accounts that a plan can have and offer to participants to automatically enroll them at 3%. So in a sense, it is an automatic enrollment provision, the PLESA. However, it does not meet the requirements to satisfy the automatic enrollment mandate. So just keep in mind that if you have PLESAs, you must also have other types of an automatic enrollment arrangement for the plan. As I mentioned, we can, have reduced the number of notices for those who are unenrolled but eligible participants. We can also, for those who are enrolled, consolidate plan notices. So of course, you have to have the automatic enrollment notice, but you can combine that with the qualified default investment alternative notice, the safe harbor notice, the QACA notice, so that process is simplified as well. And again, it's allowed if you meet the requirements that the notices are clearly identified which notice they are, the timing of the delivery is still consistent with the rules, and the language is written to be understood by the average participant. Let's move on now to the Voluntary Fiduciary Correction Program from the Department of Labor. And really good news here, they have added a self-correction element to the Voluntary Fiduciary Correction Program, or the VFCP. In the past, it always mandated an application, a filing with the Department of Labor, but now with the self-correction program, that is not necessary, but it can only be used for certain types of errors, for delinquent participant contributions and loan repayments, and also for inadvertent loan failures. So those are the only two types of errors that it can be used for. However, those represent probably the majority of plan errors that happen. Also, it's kind of restrictive as to when it can apply. The conditions are that the lost earnings related to the delinquent contributions or payments, et cetera, must be less than $1,000. So that means you can only really use this self-correction if you catch the error early on when the earnings are low. The correction also must be done within 180 days. And there must be a notice of what's called this SCC notice that the plan completes. Now, when this is the application for the self-correction is completed, put together, then the plan will receive what's called an email that is basically a replacement for what they refer to as a no action letter. You're not going to receive the letter, but you're going to receive an email saying that they've acknowledged that you're taking part of the self-correction program and that you should keep that email and have that for your fiduciary file if you need to refer to it later on. Next, we'll talk about the non-enforcement policy that the Department of Labor has in place if a plan wants to transfer small balances to a state unclaimed property fund. Now, this would only come into play, again, small balances has to be less than $1,000. And in cases where the plan has tried to find a missing participant, has gone through all the available options and the best practices that the Department of Labor has laid out, including searching for people on social media, making sure that they've checked with beneficiaries to see if they can provide an updated address. But as long as the plan has exhausted all of the available remedies to try to find the individual, if the balance is under $1,000, the plan can then transfer that balance to a state unclaimed property fund. However, it has to be a prudently set up process, and you have to ensure, the plan sponsor has to ensure that the state fund meets what's called the eligibility requirements. And there's really 9 criteria for that, which include not charging any fees against the transferred account, having a website where a participant can search for their balance, and annually, at least annually, trying to diligently search for the missing participant. And there are other criteria as well. So refer to it's a Field Assistance Bulletin 2025-01 for the details. Moving on, we also have some proposed regulations relating to catch-up contribution changes under Secure Act 2.0. Two of the sections of 2.0 are the super catch-up contributions, which are those for individuals age 60 to 63. That increase allows the individual to put up to $11,250 in catch-up contributions into a 401k plan or 403b plan for the year. Then it also addresses the Roth catch-up requirement, that if you have wages above $145,000 in the prior year, that would mean that participant could only make catch-up contributions as Roth contributions. Now, that provision doesn't go in effect until 2026. But specifically, the guidance tells us that the catch-up contributions for the age 60 to 63 eligible participants, they are automatically going to satisfy the universal availability exception. And that's really just a technical clarification that says, having that special carve out for those 60, 61, 62, 63 participants is just fine. Next, on the Roth catch-up contributions, we got some good clarification here that the $145,000 threshold on income only relates to FICA wages from the sponsoring employer, and it's for the prior tax year. And then finally, we've got some flexibility as it relates to the timing of when those Roth catch-up contributions are really designated as Roth with respect to the plan. It allows a catch-up eligible participant to make an elective deferrals as designated Roth contributions anytime really during the year. Now we've got some items that we could really use a crystal ball for to see where we are going in the future. But we know that under the Trump administration, the focus is on deregulation across the board, and that includes the Department of Labor. So far, we've had 3 mandates from the Trump administration. First of all, we had a 60-day regulatory freeze on all regulations. Next, we had what's called the Massive 10-to-1 Deregulation Initiative, which is requiring that all agencies look at their regulations and then remember that if they introduce a new regulation, they have to at least cut 10 outdated regulations from the books. So to put that into perspective, the Department of Labor issued 3 regulations last year. So if those 3 regulations are to go forward, that means the DOL would need to do away with at least 30, what is deemed to be overly burdensome or redundant regulations. So we may see a lot of culling of regulations. Finally, we've got the executive order entitled End Federal Overreach in Regulation and Enforcement. And this is really, again, a comprehensive mandate for all agencies to look at their rules, regulations, and under their respective jurisdictions to see what can be eliminated, what can be maybe cut back or pulled back or amended to make the regulations less burdensome. Now, some of the regulations that might be affected for for retirement plans include those for environmental and social governance investing or ESG investing, the investment advice fiduciary rules, and also anticipating any final regulations for ESOP plans. They're just not high on the regulation list right now. Finally, moving into our last section of our updates or hot topics here, we have a bill in Congress right now, H.R. 1013, that would allow 403B plans to take advantage of collective investment trusts or CITs. Now, if you recall, Secure Act 2.0 did have a provision in there that amended the Internal Revenue Code to allow 403Bs to invest in CITs. However, the provision in Secure 2.0 didn't go far enough to address the regulations on the federal security side, on the Securities and Exchange Commission regulations. So this bill would specifically authorize 403Bs to invest in CITs. And so we'll have to see where this bill goes. It has bipartisan support. And so I do anticipate that once we get through budgetary requirements in Congress, that we'll probably see this one come up for a vote. So let's summarize our topics for today. Number one, we got a lot of additional guidance on our Secure Act 2.0 provisions, especially related to auto enrollment, the reduced requirements for disclosures and self-correction opportunities, and catch-up contributions. It's very important because of the fast changing rules and regulations. We're getting guidance on practically a daily basis. So very important to stay informed and consult advisors and keep up to date on everything that's changing for retirement plans. And one last thing I'll say, we're looking ahead to having to amend plan documents by December 31st of 2026. So have that on your calendar to visit and make sure you address those mandatory requirements. We'll have more on that for the next time. Thanks for watching today.